Here's a number that should stop you for a second. A single top-end AI chip draws around 1,000 watts, running flat out around the clock every day of the year. Now put 72 of them into one cabinet, and that single rack pulls roughly 130 kilowatts. That's the electricity demand of about 100 homes, standing in a slot not much bigger than a wardrobe. And physics collects on every one of those watts. Whatever goes in as electricity comes back out as heat, continuously, forever. So every AI building on Earth is fighting a two-front war. Force enormous amounts of power in without a single hiccup, and haul enormous amounts of heat out before the hardware destroys itself. Today's video is about the company that gets paid to win both fronts. It doesn't design chips and it doesn't train models. It sells the machinery in between, and its stock is up more than 140% in a year. The company is Vertiv, and by the end of this video, you'll know exactly what it sells, why the AI boom made that gear dramatically more valuable, what the numbers say, and the one question that actually decides whether the stock is worth owning. Welcome to Level Up IT, the channel where we break down the technology shaping your career and your money. Educational purposes only, not financial advice. Let's get into it. Start with why this niche even exists. A data center's one unforgivable sin is going dark. For a big operator, an outage burns millions of dollars in minutes, failed transactions, ruined AI training runs, furious customers. So these buildings are engineered with layer upon layer of protection. Battery systems behind the grid, generators behind the batteries, duplicate cooling loops, and monitoring, watching all of it in real time. Every one of those layers is equipment somebody designs, installs, and services. For decades, that was a quiet, unfashionable corner of industry. Then AI detonated in the middle of it. Here's what changed. For 20 years, a normal server rack drew maybe 8 to 12 kilowatts, and the fix for heat was simple air conditioning, cold air in the front, hot air out the back. In the average rack across the world's data centers still sits under 10 kilowatts. An AI rack draws over 10 times that, and the roadmap keeps escalating. Chip designers are already talking about 600 kilowatts racks and eventually a full megawatt in a single cabinet. At those densities, air simply stops being a usable tool. Air is a lousy carrier of heat. At 130 kilowatts, you cannot physically push enough of it through a cabinet, and the fans trying would devour a fortune in electricity themselves. Liquid is thousands of times better at carrying heat away, so the industry is switching to liquid cooling. A metal plate laced with tiny channels sits directly on the chip, coolant runs through it, and the heat leaves through pipes, a radiator system, except the engine it protects is a $40,000 GPU. Hold on to this sentence because it's the entire investment case. AI didn't just mean more data centers, it made every single megawatt harder to build. Thicker electrical pathways, exotic plumbing, more monitoring, more service visits. The equipment inside each megawatt became more valuable. A company that earns revenue per megawatt of difficulty just watched difficulty explode. So who is Vertiv? Not a startup that appeared for the hype. Its lineage runs through Libert, the firm that was air conditioning computer rooms back in the mainframe age. It lived for years inside Emerson Electric, was spun out and listed on the New York Stock Exchange in 2020. Headquarters in Ohio, operations in around 130 countries. The catalog breaks into 4 buckets. Bucket 1, uninterruptible power supplies, huge battery systems wedged between the grid and the servers. When utility power stumbles for even half a second, the UPS carries the entire load until generators wake up. No UPS, no data center. Bucket 2, power distribution. Industrial grade switchgear and busway, the heavy metal rails that carry current above the racks. Bucket 3, the crown jewel, thermal management, everything from precision air conditioning to complete liquid cooling systems, including the coolant distribution unit or CDU. The CDU is the pumping station of a liquid loop, feeding coolant to hundreds of chips and handing the heat off to the building's water system. As racks get denser, a CDU stops being optional. Bucket 4, services. More than 5,000 field engineers who install, maintain, and monitor everything. Service revenue is stickier and higher margin than hardware, and once your building is full of Vertiv gear, you're calling Vertiv for a decade. And one strategic detail worth underlining, Vertiv is co-designing next generation 800-volt power architecture directly with NVIDIA, timed to NVIDIA's future chips. When the company that defines the AI roadmap picks your firm as its power partner, you're not watching the roadmap from the sidelines, you're written into it. Now the numbers, because a good story still has to cash the check. Latest reported quarter, April 2026. Revenue $2.65 billion, up 30% year over year. Earnings per share up 83%. Look at that gap. Profit growing almost 3 times faster than sales. That's operating leverage. The factories exist, the engineers are hired, so each incremental order lands mostly as profit. Operating margin reached 20.8%, up more than 4 points in a year, and management is aiming for 27% by 2030. The demand side is louder still. Backlog is orders customers have signed, but Vertiv hasn't delivered, ended 2025 at $15 billion, more than double a year earlier. In the fourth quarter, the book-to-bill ratio hit 2.9. For every dollar of gear shipped out, customers ordered almost $3 of new gear. The queue is growing 3 times faster than it's being served. Who's ordering? Mostly the hyperscalers, Microsoft, Amazon, Google, Meta, who have guided to roughly $700 billion of capital spending in 2026, overwhelmingly on data centers. Full year guidance, 13.5 to 14 billion in revenue, around 30% organic growth, over 2 billion in free cash flow, and almost no debt. Now the honest part, 2 yellow flags. First, Vertiv recently stopped disclosing its backlog figure. Companies rarely hide a metric that's getting prettier. Watch that. Second, concentration. Analysts estimate a handful of hyperscaler customers may drive close to half of revenue. When your customer list fits on one hand, a single changed mind changes your whole year. What about competition? Why not just own Schneider Electric or Eaton instead? The answer is focus. For the diversified giants, Schneider, Eaton, ABB, Siemens, data centers are one division among many. For Vertiv, they are roughly 80% of the company. The big air conditioning names, no cooling but are acquiring their way into liquid, and they lack the power side. The niche specialists are quick but narrow, one product line, no global service force. Vertiv's pitch is that it's the only at-scale vendor selling power, cooling, monitoring, and service as one package. And when you're sprinting to open a billion-dollar AI facility, one accountable vendor for the whole support system is worth real money. The counterpoint, everyone can see this market now. Rivals are pouring in, and some hyperscalers are experimenting with designing cooling hardware in-house. Vertiv leads its lane, but the lane is filling up. So here's the real debate, and it isn't about the business, is about the price. The bull case. This is a structural, decade-long build-out. Every chip generation gets denser, making Vertiv's gear more essential. Liquid cooling is still only around 10% of Vertiv's revenue, with most of the world's racks still on air, so the biggest product cycle is ahead. Margins are climbing, cash is pouring in, the NVIDIA partnership logs them into the roadmap, and the backlog buys over a year of visibility. The bear case, every word of that may be true and already priced in. The stock trades around 46 times next year's earnings. Schneider and Eaton sit in the mid-20s to low 30s. You're paying roughly double the industrial going rate for a market that has always moved in booms followed by digestion. If even one hyperscaler pauses, power shortages, permitting delays, a CFO demanding to see AI revenue, that 2.9 book-to-bill can unwind fast, and a premium multiple falls a long way on imperfect news. To own Vertiv here, you're betting that 20+% growth persists for years, margins keep marching toward 27, and hyperscaler spending never takes a serious breather. That may well happen, just know that's the bet. If you follow the stock, here's your dashboard. Green lights, margins grinding toward the 27% target. Europe, a recent weak spot, recovering, and guidance moving up. Yellow, order growth normalizing, because a 2.9 book-to-bill can't last. The question is how softly it lands. Red, any hyperscaler trimming capital spending or any earnings miss at this valuation, misses get punished brutally. The takeaway: everyone stares at the chips, but the AI bottleneck isn't only silicon, it's what's in and heat out. Somebody has to build and service that machinery for every AI facility on the planet, and right now, Vertiv is the purest single way to own that layer. Real company, real growth, real cash. The only argument is the price tag, and now you know exactly what's inside it. If this helped you see the AI boom a little more clearly, subscribe to Level Up IT. There's a lot more where this came from. See you in the next one.